Welcome back to Investing with Confidence. I am your host, Joshua David, and we are improving financial literacy worldwide. Don't forget to subscribe to Investing with Confidence wherever you listen to podcasts and on YouTube. So, Al, as we get into this next topic of how the markets really function, how they move, a lot of people think that, or don't really know why the market goes up, why the market goes down. And it's actually very similar to how prices in everyday life, anything we purchase, how that actually works as well. The concept is very similar.
Yep.
So let's talk about supply and demand, how that really works in the financial markets.
Yeah, I think most people would agree, Josh, that the relationship between supply and demand drives prices of anything. If you learned anything about the financial markets or finances in school, it's that supply and demand relationship. And it's true in any market, any financial interaction. If there's more demand for something, price is going to go up. And if there's more supply, a price will go down. So the key then is to know how to use that concept to your advantage in the financial markets. The relationship between supply and demand in the financial markets is going to determine if it's a quality trade or a trade that you should probably stay out of. And here's the key. A quality trade, by the way, is one that has a high probability of succeeding, which you should want to have, with a high profit potential, which you should want to have. Those quality trades almost always happen at or near a turn in price. So how do you identify that turn in price? It's where that supply and demand balance or imbalance happens. And in the financial markets, we're talking about buyers when we talk about demand and sellers when we're talking about supply. So if you can identify where there are buyers, and it's not just you and me, for example, buying something, it has to be buyers in a large enough quantity or trading a high enough volume, somebody like a Warren Buffett would do, or a Goldman Sachs or JP Morgan would do.
So basically the big money is
the big money.
They're the ones that are actually moving and making those turns in prices. That sound pretty
right.
Pretty fair?
Well, think about it. If at a certain price, let's say that one of the big firms wants to take a position in Apple stock, and let's say Apple is trading at $120 a share. Well, and they feel that that's a value. Well, they might want to pay $120, not much more than that. Maybe they'll go to $120.05, but they've identified 120 as the price they want to pay. They're not going to buy 50 shares or 100 shares. They may have a plan to accumulate a couple million shares of Apple. They can't get all of that filled at one price, but they will get enough filled to move the price up, because that great demand causes price to go up. When other people see the price go up, it's kind of that herding effect.
Yeah.
They start jumping in, driving the price up further. But at some point in time, it's going to come back, or may come back down to that $120 range, where Goldman Sachs or whoever it happened to be is going to buy more shares. So they do this in increments, and we can utilize that to our advantage as part of our core strategy. And part of what we think everybody should do as an investor or trader is have a foundational strategy that they use. Ours happens to be the core strategy, which, by the way, is the same strategy you use no matter what you are trading, what the time frame is. If you are a day trader, a more long-term trader, a long-term investor, it's that same basic strategy. So that really kind of simplifies things for you. But that really keys in on that supply and demand relationship, identifying what would be a quality trade. And that should be everyone's goal, a high probability of succeeding with a high profit potential. And that's part of a plan. You mentioned a plan in that first segment. That's how you also achieve confidence, is to have a plan that has been shown to work on a consistent basis. The plan, our students have a two-step plan. Step number one is using that core strategy to identify where turns in price or movement in price is going to take place, how to identify a high probability position with a high profit potential. And then the second step is identifying the right asset and the right strategy to use in whatever the market conditions happen to be at that time.
You're right. I mean, think of it this way. What I was talking about with the Apple example is these institutions, when they're purchasing millions and millions of shares, which could be billions of dollars, they are impacting that price. They are impacting the turns in price. So if they're looking to buy it, they're probably shooting that price up. And what Al's talking about with the core strategy is different ways to identify that, where they are buying, but also where they are selling. And that's how you identify that on the actual price chart, because they are leaving footprints in these price charts. And when the big money is moving that, you can see that on a chart. Think of it this way. If you're walking on a beach and right before that, they came, I don't know what it's called, a rake came over there and cleaned it up and made it nice and smooth. If you walk through that beach, and what do you leave behind you? You leave a footprint. And that's what you want to identify, is where those banks are leaving, or the big money, where they're leaving that footprint. So earlier, Al mentioned any strategy, or the core strategy applies to any asset in any market. Now, when the institutions, or the smart money, we call it, they are trading a little bit differently than the public.
They sure are.
They're not, first of all, we know they're not trading mutual funds or buying them. They're selling them.
Oh, absolutely.
But they're not only trading stock. Now, let's talk about how the smart money is creating income using these other assets.
Well, you think about the reason for being in an investment. What is your reason for being in that investment, whatever it happens to be? It's to generate a profit for you. And if that's your goal, wouldn't you want to do what you could to maximize that potential profit? Maximize the probabilities that it will succeed, but maximize the profit. I mean, it just makes sense to do that. And that's what the institutions are doing by utilizing something other than just stocks. Stocks are great for a long-term portfolio, building your wealth, but not just doing it the way Wall Street has you do it. They will tell you, okay, let's put together a portfolio that you hold on to for years. And unfortunately, a lot of people accept as truth or as fact that the only way they're going to have the opportunity to profit is in an up market, and they're going to lose in a down market. And that's okay, because Wall Street has convinced them that the market will always come back. So you just hold on. And you know what? The market does always come back, but we talk about this every week. One of the things that OTA is really concerned about is how you utilize your time, because that is a decaying asset. So if you let the market or markets take anything away from your portfolio, even if you don't sell to lock in a loss, you just let the portfolio go down. Just before you can have the ability to make $1 of profit, it has to fight its way out of a hole to come back up to where it was before. So, think about it. Buy and hold, that's what I'm talking about, that Wall Street puts people in. Think about people that held on to Enron stock, for example. They lost a lot of money doing that. Stocks most of them are going to come back, but it may take years for that to happen. So the institutions are using something in addition to that. And there are things that you can use. All of us can use these assets. They're the futures market assets. They're our FOREX, the foreign exchange market, and options. Those are assets that can be used. Strategies can be used with those to generate additional cash on a short-term basis and a long-term basis. And the great thing is that they provide leverage, very similar to a mortgage. So most of you understand what the value of a mortgage is. It allows you to own a high-priced home, let's say a $300,000-$400,000 home, for maybe $20,000 or $30,000 down. That's leverage. Now you control a $300,000-$400,000 asset for $20,000 or $30,000. You can do the same thing in the financial markets by using these leveraged assets. It's very similar to putting a down payment into a position. What it does is allows people that have smaller accounts to participate with larger valued investments. The leverage provides, it could be maybe 10 to 1, 20 to 1, 50 to 1, 100 to 1, a variety of different things based on the asset that you're using, the strategy you're using. But that's maximizing the value of every dollar you have, and that maximizes the potential for greater profits. Futures and Forex, those two assets trade 24 hours a day, which gives you a lot of versatility. A lot of people don't have time during the 6.5 hours that the stock market is open to participate, but these leverage assets like futures and Forex give you the opportunity to do it when you want to do it. And understand, just because our stock market closes, everything else in the world doesn't close. There's still a lot of activity going on that actually can impact or will impact our market, our stock market, when it opens the next day. So those assets, futures and Forex, that trade that 24 hours, give you the opportunity to participate. and at the very least know what's going to happen to our stock market when it opens based on what those assets are doing.
Yeah, I'm glad you brought that up, the whole 24-hour market, because there, I mean, we talk to a lot of people. I have a lot of friends where they say, "Oh, I can't trade and invest because I work during the day. I work 9 to 5."
Sure.
That's the stock market hours. That's only open 6.5 hours a day. With these 24-hour markets, roughly 24-hour markets, you have the opportunity to, I guess, to pick your time. If you work during the day, you have the opportunity to trade and invest in the evening. If you're an early bird, you can do that in the morning. With the futures market, that's a global market. The Forex market, that's a global market. That actually
Right.
facilitates international trade and investment.
Right.
A lot of people love that market because it's a slower moving market. Some people are afraid of the stock market because it's so volatile. That's actually a good thing. But with the Forex market, that's very, very slow. And when Al's talking about the futures market, that's like your stock markets, your S&P 500,
Commodities.
the commodities, the Dow, your interest rates, the 30-year bond, the 10-year bond. My favorite. Let's you say it
I
today.
would say lean hogs.
Lean hogs. I give you that's my thunder, but I'm giving it you today. But that's the thing, is there's other opportunities that most people just don't know about. And when he's talking about the down markets, there's opportunities there.
Right.
The term is called shorting. And basically what that means, if the market goes down, there's an opportunity for a potential profit there. And a lot of people think it's just that buy and hold strategy, which is only a up market position. Now, with these other assets, we're seeing so many people understand, okay, there's more out there. There's more than just mutual funds, which we don't really want to swear like that on the show, but there's more than stocks too.
Right.
So a lot of people are feeling they are missing out on some great opportunities coming up in this next segment with longer term horizons, trading and investing for the longer term. But we're not talking about buy and hold, which over time is not a very good strategy because you lose that time. So coming up next, we're going to talk more about retirement, longer term strategies, different techniques and concepts that investors have available there. We'll talk about self-directing, which Al will get into, but also some of the different techniques that the institutions are using that we don't even know that are available. They actually are available to the public. This is Josh and Al with Investing with Confidence.